On August 4th, 2026, one stock added more market value in a single day than most companies are worth in their entire lifetime. Palantir, up 29.5% in one session. Investors who held overnight woke up richer by literally billions of dollars, collectively, before they'd even had coffee. And normally, when I bring you a stock story like this, it's a good news story. Beat earnings, stock goes up, everybody's happy, roll credits. This is not that video, because buried inside this amazing quarter is a number that should make every single person watching this a little nervous. Not about Palantir specifically, but about what's happening across the entire AI trade right now. A trade that a lot of very smart, very rich people are quietly starting to bet against. So let's break down what actually happened, why it's genuinely impressive, and why the same earnings report that made bulls euphoric is also flashing one of the clearest bubble warning signs we've seen all year. Let's get the facts straight first, because the headline number, up 29%, doesn't tell you anything on its own. Stocks jump on hype all the time. This one jumped on numbers. Palantir reported second quarter revenue of $1.94 billion, up 93% year over year. For a company already doing close to $1 billion a quarter the year before, growing revenue by 93% isn't just good. It's the kind of growth rate you usually only see in tiny startups, not in a company already worth over $100 billion. Adjusted earnings came in at 41 cents per share, comfortably ahead of the 34 to 35 cents Wall Street expected. Net income was $1.07 billion, more than 3 times what it was in the same quarter a year earlier. But here's the number that really moved the stock: guidance. Palantir didn't just beat the quarter, they raised their full-year revenue forecast from around $7.66 billion to as high as $8.16 billion. That's nearly a $500 million increase in expectations in a single update. And CEO Alex Karp, never a man to undersell anything, called the quarter otherworldly. His words, not mine. He told investors that no business at our scale has grown half this much, and framed what's happening as a sovereign AI revolution, with companies and governments rushing to build AI systems on infrastructure they control, rather than renting it from outside AI labs. On the surface, this is one of the best corporate earnings stories of the year. Before we get to the scary part, let's give credit where it's due, because you need to understand why Wall Street got so excited, to understand why the excitement itself is the risk. Palantir's U.S. commercial business, meaning private companies, not governments, grew 149% year over year to $764 million. That's not a rounding error. That's a business more than doubling in a single year, at a size where doubling should be getting harder. Government revenue, meanwhile, grew 90% to $809 million, at a time when defense and security budgets across multiple governments are expanding rapidly. And crucially, this wasn't growth bought with losses. Palantir posted a 62% adjusted operating margin. For context, most software companies would consider themselves thrilled with half that. Revenue grew nearly 3 times faster than operating expenses, which is the kind of operating leverage every investor dreams about. Like a movie theater that already paid for the screen and the seats, so every extra ticket sold is almost pure profit. They also closed 220 deals worth $1 million or more in the quarter, ended it with $13.1 billion in remaining contracted deal value, up 83% from a year ago, and generated $1.22 billion in free cash flow. So no, this isn't a story about a company faking growth with accounting tricks. The growth is real. The demand is real. That's actually what makes what comes next more interesting, not layoff. Here's what almost no headline mentioned. Even after an otherworldly quarter, even after a stock that gained nearly 30% in a day, Palantir shares were still down roughly 29% for the year, at one point in 2026, driven by growing concerns that the broader AI software trade was running out of steam. Read that again. The same stock, the same company, swung from deep losses to a massive single-day rally on the same underlying business. That kind of volatility doesn't happen around companies that are cheaply priced. It happens around companies priced for perfection, where every earnings report becomes a referendum on an entire industry's future, not just one business's quarter. And that's really the story here. Palantir isn't just a stock anymore. It's become one of the most watched proxies for a question the entire market is quietly obsessed with. Is the AI boom real, sustainable growth, or is it a valuation bubble sitting on top of real technology? Because here's the thing about a stock trading at the kind of multiple Palantir trades at. A multiple that assumes not just continued growth, but continued acceleration for years. A single otherworldly quarter doesn't just move the stock 5% or 10%, it moves it 29% in one day. Because at that valuation, the market isn't pricing in good, it's pricing in perfect. And perfect just barely got confirmed, which raises the obvious question. What happens the first time it doesn't? You might recognize the name Michael Burry from The Big Short, the investor who correctly called the 2008 housing crash years before almost anyone else took it seriously, while being mocked, doubted, and nearly fired by his own investors for it. Burry has recently gone on record saying something that should get your attention, regardless of what you think of him personally. He believes we are near a major top in this market, comparing conditions to 1987, the year of the largest single-day stock market crash in modern history, when the Dow fell over 22% in a single session. Now, Burry being early or wrong before doesn't automatically mean he's wrong now, and being right before doesn't guarantee he's right now either. Nobody, including him, has a perfect track record. That's not the point. The point is what he's actually pointing at. A market where an enormous share of total value is now concentrated in a small handful of AI-linked companies, all trading at valuations that assume years of flawless execution, funded in part by enormous amounts of capital expenditure, and as we've covered on this channel before, a growing pile of debt used to build AI infrastructure that isn't always visible on the balance sheets investors are looking at. Palantir's earnings didn't cause that risk. A 29% single-day pop on already elevated shares is a pretty clean example of exactly the kind of behavior people like Burry are worried about. Not because the company is bad, because the price already assumes the company can do no wrong indefinitely. Let's make this concrete, because priced for perfection sounds like a vague finance phrase until you see what it actually means in practice. Imagine two companies. Company A trades at a modest valuation, say 15 times expected earnings. If they beat expectations by 20%, the stock might rise 8 to 10%. If they miss slightly, it might drop a similar amount. The stock has room to be wrong in either direction without catastrophic consequences. Company B trades at a valuation that already assumes years of 80 to 90% growth, continuing indefinitely. If they beat expectations, even by a lot, the stock might jump 20 to 30% because the market is essentially saying, okay, the fantasy scenario is still alive. But if they merely meet expectations, or beat by a smaller margin than the market wanted, the stock can drop 20 to 30% just as fast, not because the business got worse, but because the assumption of perfection took a hit. That second company is where a lot of the AI trade lives right now, and it's not a criticism of any single company's fundamentals. Palantir's numbers this quarter were genuinely excellent by almost any normal business standard. It's a description of what happens to a stock price when growth expectations get so extreme that excellent and not quite excellent enough start to look identical to the market. Both can trigger 20 to 30% swings, just in opposite directions. This is exactly the dynamic that shows up right before market tops throughout history, not because companies suddenly become fraudulent, but because expectations quietly detach from what's mathematically sustainable. And it only takes one disappointing quarter, anywhere in the group, that trees don't grow to the sky. Every generation of investors gets warned. This time it's different. And sometimes they're right, and sometimes that phrase becomes the epitaph on a multi-trillion-dollar mistake. In the late 1990s, internet stocks rallied on real technology, real disruption, real companies that ultimately did change the world. Amazon, eBay, and others from that era are titans today. But the prices investors were willing to pay in 1999 assumed every single company in the sector would become the next dominant winner, when in reality, most of them didn't survive at all. The parallel to today isn't that AI is fake, it's clearly not. Palantir's revenue growth is real revenue, from real customers, solving real problems for governments and Fortune 500 companies. The parallel is in the pricing. When a whole sector gets priced as if every company in it will be a dominant, decades-long winner, the market isn't really pricing individual businesses anymore. It's pricing a story, and stories can change overnight in a way balance sheets can't. The uncomfortable truth is that we won't know which era this actually resembles until years after the fact. Nobody ringing the opening bell in January 2000 knew the crash was 3 months away. Nobody at Palantir's earnings call in August 2026 knows exactly how this ends either. Not Alex Karp, not Michael Burry, not the analysts on CNBC, and definitely not me. What we do know is what the pattern looks like while it's happening. Extreme valuations, extreme single-day moves on earnings, an entire market narrative resting on the success of a small handful of companies. We've seen that pattern before. Sometimes it resolves into a soft landing. Sometimes it doesn't. So what do you actually do with all of this? Because the market might be in a bubble or might not be, isn't exactly actionable advice. First, don't confuse a great earnings report with a safe stock price. Those are two completely different questions. Palantir's business, based on this quarter, looks genuinely strong. Whether the current stock price appropriately reflects that strength, after a 29% one-day jump on top of already elevated levels, is an entirely separate question, and the two get confused constantly by people watching the headline number instead of the valuation underneath it. Second, concentration risk is real, whether you own individual AI stocks directly or just own an S&P 500 index fund. A handful of AI-linked companies now make up a historically large share of total U.S. market value. If you think you're diversified because you own an index fund, it's worth actually checking how much of that fund's performance depends on the same 5 or 6 names driving daily moves. This one. Third, and this is the boring, unsexy advice that actually matters. Volatility like a 29% single-day move in either direction is a symptom of a market that's making big, binary bets on the future. That's not inherently bad, and it's not a reason to panic sell everything, but it is a reason to be honest with yourself about how much of your portfolio's performance is riding on a handful of companies staying otherworldly. Karp's word, forever. Because eventually, mathematically, every company's growth rate slows down. The only question the market hasn't answered yet is when and how the price reacts when it does. Palantir didn't do anything wrong here. If anything, they delivered one of the best quarters any software company has posted in years, and investors rewarded that, exactly the way markets are supposed to work. The warning isn't about Palantir. It's about what a 29% single-day reaction to one earnings report tells you about how much the entire AI trade is now leaning on a handful of companies continuing to deliver otherworldly results, quarter after quarter, indefinitely, with very little room for anything less. Markets can stay euphoric for a long time. They can also turn on a single disappointing headline. Nobody rings a bell at the top. You usually only find out you were at one in hindsight. If this helped you actually understand what's happening behind the headline number instead of just the headline itself, hit subscribe, because that's exactly what this channel is going to keep doing every single week.